Well, good morning, everyone. It is 10 o'clock, so we can go ahead and get started. And because we are virtual, I have my script to read, so I'll commence with that. Thank you for joining us for the Oklahoma City Employee Retirement System meeting. We have a few announcements to make before the meeting begins. If the video conference is disconnected at any time during the meeting shall be stopped and reconvened once the connection is restored. If communication is unable to be restored within 15 minutes, the meeting will reconvene today, May 13th, 2021 at 11:30 a.m. via teleconference. The agenda and documents are located at okc.gov. Anyone wishing to speak about an agenda item, public hearing, or to be included in the citizens to be heard, please call 405-297-2391 or text 405-219-7927. Please provide your name, phone number, the item number, and the reason you wish to comment. If you call in after your item has been heard, you will be allowed to speak under citizens to be heard. Speakers will be allowed 3 minutes to comment. I ask that all participants, except board members, keep their phones on mute until they are recognized to speak. Board members will be allowed to ask questions or comment at any time during the meeting. So with that, I will call the the May 13th meeting of the Oklahoma City Employee Retirement System to order. The first item on our agenda is item number 2, to approve the minutes of the meeting of April 8th, 2021. I have a motion and a second on item 2. Please record your vote.
Trustee Nichols, do you have voting buttons? You're muted. You may need to press escape on your keyboard to minimize Zoom.
Okay, I tried escape.
And then click on the Chrome button in your start bar.
I did, and I still don't have voting buttons.
Okay, how would you like to vote?
Yes,
Trustee Donata, do you have voting buttons?
I don't.
How would you like to vote?
Yes.
Item is approved. Item number 3 on our agenda is the consent docket. There are 4 items. Does anyone have any questions on any of the 4 items? Hearing none, the chair will entertain a motion on item 3. I have a motion and a second. Please record your vote.
Trustee Nichols,
yes,
Trustee Donata,
Yes.
Item 3 is approved. Item number 4 is to ratify approvals. We have 4 items. Any questions on any of the items under number 4? Hearing none, chair will entertain a motion. A motion and a second on item 4. Please record your vote.
Trustee Donata,
Yes.
That item is approved. Item number 5 is to approve the claims docket. I have a motion and a second on item 5. Please record your vote.
Trustee Donata,
Yes.
That item is approved. Item number 6 is to approve the following applications for service retirement. We have several this month. I have a motion and a second on item 6. Please record your vote.
Trustee Janata,
Yes.
trustee Madera, do you have voting buttons? Thank you.
The item is approved. Item number 7 is ratify approval of continuation of pension to the spouse. I have a motion and a second on item 7. Please record your vote.
Trustee Janata,
Yes.
Item 7 is approved. Item number 8 is to receive the report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. I have a motion and a second on item 8. Please record your vote.
trustee Janata,
Yes.
Item is approved. Item 9 is to receive the report of death, authorize secretary to make necessary changes to conform on the following. I have a motion and a second on item 9. Please record your vote.
trustee Janata,
Yes.
Item is approved. Item number 10 is to approve the request of the following to terminate vested rights and commence retirement benefits. I have a motion and a second on item 10. Please record your vote.
trustee Janata,
Yes.
Item is approved. Item number 11 is to ratify approval of the following to terminate vested rights and receive a lump sum distribution of his or her employee contribution account. I have a motion and a second. Please record your vote.
trustee Janata,
Yes.
That item is approved. Item number 12 is items for individual consideration. Item 12A is contract with Allen, Gibbs, and Hewlett LC Audit Services for fiscal year 2021. Fee not to exceed $24,033, July 1st, 2021 to June 30th, 2022. Anyone have any questions on item 12A? Hearing none, Chair will entertain a motion. Have a motion and a second on item 12A. Please record your vote.
trustee Janata,
Yes.
Item is approved. Item 12B is a subscription agreement for additional shares of the Morgan Stanley Prime Property Fund in the amount of $14 million. Jason, would you like to?
Sure. This
Speak
is
to
really, we would consider this rebalancing. Morgan Stanley Prime Property Fund is your core real estate manager. We're underweight in real estate. To add dollars, you have to, you do it via what's called this additional subscription. And they actually needed some documentation that the board approved the additional subscription. So the 14 million is just to bring them up closer to the 10% target for core real estate.
Does anyone have any questions for Jason on this item? Hearing none, Chair will entertain a motion. Have a motion and a second on item 12B. Please record your vote.
trustee Janata,
Yes.
Item is approved. Item number 13 is to receive investment consultant reports. Item 13A is the monthly investment report.
I'm going to take it in a little different order and cover a few pages from the quarter report, if that's okay, Mr. Chairman. And
That's quite all right.
Okay. Well, thank you. Good morning again, everyone. Just touch on a few items. The portfolio results have been very strong, as we know. Markets have been the last year a significant rebound off the bottom in February and March of last year at the early part of the pandemic. I'm showing a page here, just showing in terms of dollars, the growth of the portfolio. And that first column there, the 1 year, this would really be right about the beginning point. April of 2020 was pretty much the bottom, about a week after the bottom. And at that time, the total fund stood at 674 million. At the end of March, you can see the total portfolio was at 894 million. And at the end of April, the total portfolio was over 900 million. So closing in on $1 billion. So pretty just astonishing growth in terms of dollars, a $250 million increase over the course of that 1 year time period. So really strong results. The story really continues to be at the first half of the rebound from March really through October. We saw those companies, particularly large cap growth, technology-oriented companies that were really benefiting from low interest rates and the stay-at-home, work-from-home economy. As we've talked about in calendar year 2020, 50% of the return for the S&P 500 or U.S. large cap stocks came from 5 names. Really the high large cap, mega cap, growth-oriented names: Tesla, Amazon, Apple, Google. Those names really represented 50% of the return of the market. Since that time, since November, where we started getting more positive news on the potential of a vaccine, and then really continuing through today, we've seen a pretty big turnaround in the market. Through the the last quarter of the calendar year, really all sectors, including technology, continue to stay positive. But really the value-oriented sectors, financial, energy, more economically sensitive sectors that would benefit from the reopening of the economy started to outperform over the course of the next several months. This year, we have seen a bit of a choppy market, particularly in some of the technology names, as rates have gone up a little bit. That's had an impact on some of these names that really had been benefiting for the last 10 years. That said, rates still aren't very high. We're at about 1.7% on the 10-year, where historic, that's up 100 basis points over the last year. But historically, on a 3-year basis, we're still down about 127 basis points from where we were 3 years ago, with the 10-year closer to 3% 3 years ago, and that's still fairly low historically. This month, we have seen a bit of a further sell-off in technology, although today the market's really bouncing back. But it's not surprising to see this kind of volatility and kind of the turnover in leadership in the markets to more value-oriented companies. As we look at your portfolio results, just relative to other measures, the policy index and peers on a 1-year basis, and we looked at this last month, that $290 million return equates to about a 38% return relative to your policy index, which was up 33.5%, which is an indication that your managers and your allocation is doing actually quite a bit better than what the asset allocation would suggest. And you're really getting good relative returns from all sectors of your portfolio. And we'll look at this in a bit when we look at the monthly results. That 1-year return relative to other public pension funds ranked in the top third. And you can see over longer time periods, 3, 5, and 10 years, the portfolio rankings, really quite good, top quartile, top 20%, almost top decile over the last 10 years in the 14th percentile, longer term over that 10-year period, which means you're outperforming 86% of public pension funds over that time period. So we're really, really pleased with that. I'd say from a risk standpoint as well, we'd like to see this. We talk about this quite a bit. We're happy to participate when markets are going up, but we don't have to get all of the upside. The portfolio is really allocated in a way and implemented in a way where we should get some protection when markets are going down, because longer term, it's more important to lose less when markets are going down because your assets will compound at a greater rate. And we've really got that over the last 10 years. What this is showing is you've gotten a higher return than the policy benchmark with a little bit less risk in terms of volatility risk. So your standard deviation, which is volatility, is a little bit lower than the policy index. And we've done that through a couple of things. The long short equity certainly provides a hedge against equity market volatility, as well as just some of the managers that you're utilizing tend to be a little bit less volatile. Where we have probably seen a little bit more contribution to dispersion or volatility relative to the policy index is on the fixed income side. I don't normally talk about it in those terms, but the way your fixed income is implemented, you have a lot more, the managers that you're utilizing in Western or PAMCO, Brandywine, previously PAMCO, which is a lower volatility hedge fund strategy, and now that's being replaced by PGIM. Those strategies have a lot less interest rate exposure, more exposure and the ability and flexibility to move into corporate credits, non-US bonds, emerging market bonds, to provide some other return drivers. That actually has contributed a little bit to volatility relative to the policy index, because it doesn't behave like the US investment grade index that we're comparing to. And that is intentional, because as rates come down, bond prices go up, but as rates go up, bond prices go down. And as a long-term investor that needs a 7% return over time, we're trying to maintain principal protection and lower volatility strategies with the fixed income, but also have some other return drivers in fixed income. So when we looked at this last year, your fixed income portfolio really trailed the aggregate benchmark. But as of the end of April, your overall fixed income allocation was up a little under 8%, 7.8%. Whereas the benchmark aggregate index was actually negative, down 27 basis points. So that's good dispersion on the upside as markets have rebounded. I'm gonna let's just switch. I'm sorry. Trying to switch to the monthly report. Here we go. So just looking at the monthly report in terms of asset allocation at the end of April, what we just talked about with the rebalancing to real estate, as equities have gone up, your overweight equities, we continue to be underweight real estate, and that underweight has actually grown a bit just because of how good equities have done. We have done some things in the opportunistic real estate. You've made commitments to the Starwood Distressed Opportunity Fund, a $15 million commitment. That will start to bump that up, but none of that has been called yet. We anticipate you'll start getting some capital calls there here in the near future. But your core real estate, which is the Morgan Stanley Prime Property Fund, also underweight. This 14 million will get that up closer to the target weight. That'll probably take a couple of months, maybe a quarter, to get put to work. They don't call that all at once. but we do anticipate it will be called over the next quarter or so. So you have a little bit more in cash than normal, about 19 million. In talking with Regina and Matt, we're comfortable with holding a little bit more cash. That is probably about 4.5 months of operating needs. It will also help fund the real estate when that's called. In reality, we're more comfortable holding that than allocating it somewhere liquid right now and getting more overweight to equities or more overweight to bonds. So we kind of look at that as at this point in time, we're comfortable with that. But it will be called a portion of that over the next few months, but you won't have to raise any money for operating needs, probably for a couple, 2 or 3 months. Just touching on the individual asset classes, as I mentioned, this is rolling forward a month through the end of April. So the 1 year at the end of April, the total portfolio up a little over 32%, net of fees at 32.3%, Treasury policy index up 28.2%. So a 5% premium to what the policy index would suggest. And like I said, that's really coming from a few areas across the portfolio. Your large cap allocation, which is the largest allocation overall, you have 23% of your total assets within large cap, outperformed by about 6%. That's really coming from Intech. You have about half of your large cap assets, or a little more than half, are with Intech, which is a benchmark risk controlled strategy. They use what they call a volatility capture approach, but essentially you're getting it at a very low cost. It's almost like an index type fee, a little bit more expensive, but much less expensive than a traditional active manager. And they're generally what they do is they build a portfolio that tends to overweight the smaller companies within the large cap index for this strategy. In periods of time where smaller cap names are outperforming, this strategy will generate pretty significant excess return. And we've seen that in the last year. They've added about 700 basis points relative to the benchmark. And that's where we're getting that excess return there. Small cap up 70.5%. The benchmark over this period up almost 72%. It's the best performing asset class on an absolute basis. Slight negative dispersion relative to the policy benchmark. We have no concern about this. The December and January were pretty challenging months for active small cap managers. We've talked about this a little bit. We saw very low quality companies outperforming. Low quality companies meaning companies that were heavily shorted in the market based on their fundamentals. They looked like they were going bankrupt. GameStop is the most prevalent of those names. Well, those names like that are in the index. Your fundamental managers that you have, active managers, aren't owning those names. In the month of January, that caused probably about 500 to 600 basis points of negative dispersion relative to the index for those managers. We're comfortable with that. We wouldn't expect them to own those types of names. So that's what's causing that little bit of dispersion relative to the benchmark. The long short equity composite up 34%. This is an area that this allocation is intended to provide protection when markets are going down and participate when markets are going up. So relative to long only global benchmark over the last year, when things have gone straight up, we have trailed a bit, but compared to an index of other equity-oriented hedge fund strategies, this allocation, the K2 Mauna Kea portfolio, has added about 400 basis points. So this is really doing what we would want it to do. Last year in February and March, the Mauna Kea platform, when equity markets sold off 30-40%, it provided significant protection and was down less than half of that. So it really was doing what we would expect it to do in providing that protection. The private equity portfolio, really a good year for private equity. There were a lot of distributions over the last year in the portfolio. Private equity lags public markets. It's not going to track what's happening in the public markets, although there was pretty robust M&A activity and IPO activity in 2020 and the early part of 2021, where a lot of the companies within your private equity portfolio were either acquired by other buyers or there were IPOs, which then led to distributions. When those companies are sold, that money is returned back to you in the form of distributions. And you're seeing that reflected in returns. Longer term, really good returns from the private equity portfolio, almost 13% return over the last 10 years. A little bit behind the S&P 500, but it's been a period of time where the S&P has been the best performing asset class. As we look forward, you may recall when we did asset allocation work in January, our expectations going forward for large cap equity, just based on where we are in terms of valuations, the cycle has been pretty long in the tooth. Our intermediate term assumptions for large cap equity in the next 5 to 10 years are more like a 5 to 6% return annualized. Think about that in terms of this 1 year return, where the benchmark is up 45%. That's about almost 8 years of return pushed into 1 year. So we're still going forward much more muted expectations. We think the opportunity within private markets is attractive for managers to be able to add value going forward. And as part of your asset allocation, we've bumped up the target allocation to private equity from 5 to 10%. You're about a little bit less than half of that now at 4.7% actually allocated to private equity. So we're going to have to continue to make commitments there. Made in 2020 commitments to 5 funds, the 2 first mark funds, the Carvel distressed credit opportunity, and then 2 Francisco partner funds. And that was about a little over 25 million in commitments. We'll have to keep that pace up, and it's probably going to be 2 or 3 commitments a year in the private market space to continue to move that toward the 10% target. Finally, non-US equity, very strong returns from both your developed managers, Lazard and Hardin Loevner, as well as your emerging market managers in Wells and Wasatch. You can see absolute returns close to 50%, but the relative returns very strong. And then finally, fixed income, as I mentioned, really strong results there. Much of that coming from the Brandywine strategy, which tends to have more non-US bond exposure, benefiting in the last several months from decline in the value of the dollar relative to foreign currencies, really getting a benefit there. And that Brandywine strategy on a 1 year basis is up almost 19% relative to the aggregate benchmark, which is down 27 basis points. So you can see you're really getting a nice bump there. But overall, portfolio continues to perform very well. I think the emphasis right now is just trying to get managed a little bit to the targets, not letting risk run up too high, continuing to rebalance back from equities a little bit where we can, and getting the real assets up closer to target.
Okay, does anyone have any questions for Jason on either the monthly or the quarterly investment report? Hearing none, the chair will entertain a motion on items 13A and B. I have a motion and a second. Please record your vote.
Trustee Janata,
Yes.
trustee Nichols. You're muted.
Yes.
Trustee Madera,
Yes.
That item is approved. Item number 14 is comments from board, staff, and citizens. Anyone have anything for the good of the cause this morning?
Yeah, Mr. Chairman, I'd like to bring something up. Actually, a congratulations to Asset Consulting Group for the Greenwich Quality Leader 2020 Award. Some of you all might have seen that letter, but for the benefit of our retirees or others that may be watching this meeting, the letter stated that ACG has again been recognized as a Greenwich Associates Quality Leader, marking the third consecutive years they have received this distinction within the industry. Greenwich Associates is a leading financial services research and consulting firm that conducts our annual survey of more than 1,000 institutional investors across the U.S. to acquire objective feedback on the services provided by their investment advisor. The survey ranks advisors based on several criteria and grants the quality leader designation to the top 3 firms nationwide. And I think that's a really good testament to the leadership and quality of advice that we get from ACG. And Jason, to you and all of your associates, congratulations for receiving that. And I think we'd all agree that we're happy to have you.
Thank you very much. I appreciate that.
Okay. Thank you, Marty. Anyone else have anything?
Chairman,
Yes, ma'am.
I just wanted to remind or let everyone know that we'll be back to in-person meetings by the time we have this meeting again.
Next month.
We'll be in council chambers.
Okay. Regina, anything from the office?
I don't think we've started with the consulting group. We're doing testing with them. So we're meeting with them on a weekly basis to get an update, but they just got VPN access and have started testing.
Okay. Okay.
Can you please make sure we have the address for the meeting next month, please?
Absolutely.
Okay, thank you.
Okay. Item number 15 is adjournment, and we are adjourned at 10:33 a.m. Thank you, everyone.
Thank you all.
Thank you.
Thank you.